Welcome back, traders and investors. We have Tim Melvin of the Deep Value Ladder. Tim, is there any value left in this market?
Not a lot, Joel. I have to tell you, right before we came on this morning, I ran a screen, just your basic, safe and cheap measures that I use. It's an 11,000 stock database. I've got 44 stocks that fit the definition, and that's before doing any, further investigation. This is just a quantitative screen. Of the 44, seven are based in China, so they go right out the window. I won't invest in China or Russia. I don't send my money to places that don't like me. Um, so
Okay.
that leaves 37 stocks that fit the basic definition of safe and cheap. Seven of those, Joel, are over 100 million in market cap.
Uh, could you just give
What?
us a historical perspective on that? I mean, from like in the depths of the financial crisis until the lowest you've ever seen. Can you just give us a
That
perspective on
we're
that?
we're banging around the lowest levels I've ever seen.
Okay.
This
For
is
value.
very, very close. At the depths of the financial market, there's probably 1,500 stocks that would make the cut initially. I mean, you could. It was ridiculous how cheap stuff got back in late 2008,
Yeah.
2009. You could
Yeah.
sort of pick what you wanted to buy. That is not the case today.
What stock? What one's jumping right out at you, popping out, saying this is the one? So you said you got seven good ones, seven over 100, with 100. What did you say?
Yeah,
$100 million
yeah,
market cap?
yeah, let me give you two that we just bought in the
Sure.
income and value portfolios, just because they're so cheap. They're both REITs, very small REITs. One's 500 million in market cap, one's about 125 million. They're really just everybody's ignoring them. One's preferred apartment communities. That's APTS is the symbol. And
APTS.
yeah, as as the name says, they are in the multifamily housing game, which has been a hot sector, but it's only 125 million market cap, so nobody cares about it. The funds and ETFs can't, play with it at all. They own and also finance multifamily housing units, and the thing's at 75% of book value, yields over 7.5%, and fundamentally the balance sheet's in great shape. Nobody cares. I love the thing. It's
So you
spitting
think that 7% yield is safe, is what you're
that's
saying?
yeah, that 7% yield is good. Same for Campus Crest Communities, which they're in the student housing business.
What's the symbol on that one?
CCG,
CCG.
yeah. And here again, trading at less than 80% of book, balance sheet's fine. They own student housing apartment complexes, and they're actually growing. I mean, they've gone from like 12,000 units 4 years ago to over 45,000 units today. And again, you've got a 7.5% plus dividend yield, trading well below the asset value. And because of the size, 520 million, it's not in any of the indexes or ETFs, and just absolutely nobody cares about this thing.
So
What
what's going
happened back on February
Yeah.
27th when it had that huge gap down day? Because that's always a
Missed,
red
missed,
flag.
missed estimates.
That's what it was? Okay, it
Yeah,
was off earnings.
and I love a missed estimate. I mean, the only
You
thing
you
makes
like the missed estimates. You're one
sure.
of
The
those
only thing I like more than
contrarian
missed
guys.
estimate is the only thing I like more than missing estimates is a dividend cut.
You like the dividend cuts? Well, what if you own the thing?
Well, okay, then you didn't do the work. You didn't do the work ahead of time, because if a dividend cut's coming, it won't pass the safe and cheap tests. I
Okay,
very
so
rarely get surprised by a dividend cut with a stock in the portfolio, but afterwards they usually sell off, and creates quite an opportunity. Boardwalk Pipeline being the most notable last quarter, we picked that thing up at half a book value.
what is that symbol on that one?
That's BWP, and
Oh, that's BWT. Yeah, yeah, yeah.
yeah, they slashed the dividend in that thing, and all the high yield MLP buyers got out of it. Um, you know, Doom, gloom, their contracts are rolling over, life is horrible, and everybody forgot to look and realize, Lowe's Corp, which is controlled by the Tisch family, owns most of this thing. Do you really think they're going to write off their investment in what is actually a pretty valuable network of pipelines? I don't.
What now? The other charts of the two REITs that we looked at. I mean, it's just they're not very sexy. They're just sitting there and consolidate,
To say it
consolidating.
nicely, Joel.
Yeah, I mean, look,
No, no,
if you
let me finish. Let me finish. And they missed on earnings. So what's gonna? Is it you just looking for another good earnings report to bring it out of that kind of consolidation phase? Is that going to be the driver?
I have no idea.
Okay.
Okay. Well, I buy based on safe and cheap. Okay. At some point in the future, whether it's today, tomorrow, maybe it's 5 years from now,
Yeah.
something will come along to unlock the value of this thing, improve the earnings, Takeover is always a possibility. We have a very high takeover rate in all of our portfolios. Because I don't have the only pencil and calculator in the world, and cheap assets are cheap assets. There's a good chance somebody will buy them. Often we get an activist presence, particularly in the smaller banks, that comes in and forces a large buyback or dividend or a sale that unlocks the value. If you get a stock that doubles in 5 years, that's better than 15% rate of return, that plus dividends. So I'm fine with that. I'll sit and hold these things as long as it takes.
For the listeners who haven't heard Tim before, I think the main thing to stress about you is that your time frame is super, super long, right, Tim? Like, how long are you typically holding a stock for when you put it in your portfolio?
My average is probably 4 years, but my
4 years.
Yeah, my time frame, when people ask me, I just say until it works.
Right. Because exactly. So he's not a trader here, folks. Like, he's not looking at this, jump, and this is going to move next week. He's got time on his side. So if you're looking at these things and, you need the money next week, this isn't the trades for you. These are long-term investments he's looking at. So we like to give you a good perspective here on pre-market prep. And Tim is on the opposite end of the spectrum where he's very long-term. So we like this, though. We like, these different ideas for, because even in my portfolio, I run it, as a trader, I still have a long-term investing portfolio as well. And I like it when I see stuff like this, and so you basically look and you crunch the numbers and you say, hey, this is trading very cheap relative to book value. The assets are being valued very cheaply here, and I think it's just a good investment, right, Tim?
Right. I mean, and once we identify cheap, we come back through and we identify safe. And, there's two ways of finding a margin of safety in a stock. One is in that discount from book value. Okay, if you own $10 worth of assets for $6, you've got a little bit of a margin of safety in there. But we also go into the balance sheet and the income statement to a lesser degree. I'm very balance sheet focused. And we make sure that these guys, they can pay the bills, that this business is going to be either self-financing or they have ready access to financing. They're not going to have to close the doors and, go into bankruptcy or liquidate or anything. So we're looking for those two levels of a margin of safety. We want to make sure this company can survive long enough to thrive again.
Tim, you said, as far as your time frame is like, till it works. But, obviously not every trade that you have works out for you. I mean, what?
Yeah, I'm actually glad you brought that up because, yes, we have a 15-point model, okay, for margin of safety, I'll call it. I call it a credit and fundamental model. Stock can't go into the portfolio unless it has an 8 or better. If it slips to a 5 reading, that indicates to me that the balance sheet, something's going wrong here. Okay, it's getting worse. I'll dump the stock and take my loss.
Okay, good. No, that's good because we talk a lot about risk reward ratios, and that's important. Tim, just going to a little general market talk. In the early last week, we were just having some just really wicked volatility in the market, and a couple dives midday. I thought that was just signaling the end, because usually when the volatility ramps up, that is sometimes precursor volatility on the downside, and then this market just turned around on a dime again. Is there anything that you're seeing in the overall market that has you concerned?
Well, sure. I mean, I'm not a market timer, but if you look at the big picture stuff, Joel, the Shiller P ratio, the market cap to GDP, the value line median appreciation index, all of these things are signaling a market it's on the high side of fair. Does that mean it's going to correct tomorrow? No. And if you ever catch me predicting that it's going to correct tomorrow, buy, okay? Because I'm usually wrong. There's not a lot of cheap stocks. Clearly, stocks are overvalued relative to what Sam Zell called the real level of economic activity. But that can go on for an extended period of time. And I try not to worry about the day-to-day fluctuations of the market too much unless it creates an opportunity to buy safe and cheap stocks. And last week I did something really interesting. For the first time ever, I went on vacation with the family. For the first time ever, I unplugged. I didn't work. So usually a vacation for me has been sitting in a really nice hotel room working while everybody else had fun.
Yeah.
I allowed myself 2 market checks a day, 1 in the morning, 1 at night, just to make sure nothing horrible or wonderful happened to the portfolio. Other than that, I ignored it. And you know what? I didn't die.
And I know. Sometimes you think that
Really?
you leave on a Friday, you come back on a Friday or on a Monday, and the market is exactly where it was. Tim, just overall, I mean, you're comfortable with the positions in your portfolio. You say you're not a market timer, but do you have any? We like to call them lotto ticket pooks or lotto, options on, just in case, because you're obviously net long. You're not, you don't have any short. And correct me if I'm wrong. If you have any short exposure in the market,
No.
do you keep anything in your hip pocket for that potential disaster, or is it just wasting money because you're paying so much on the premium that even if the market does correct or has a big down move, you're breaking even on your options anyways?
Pretty much. Yeah, no, I've never been net short in my life. Every once in a while, I mess around with some chicken shorts and I'll buy put spreads on some of the really overvalued stuff. And it's my version of going to the racetrack, really. And that's just play money. But no, the nice thing about deep value investing is I'm not a market timer, but there's a forced element of market timing. Because we keep our position sizes relatively small, 1-2% initially, they've got to grow up to be bigger. As markets move higher, we find ourselves selling a lot of stocks because they've reached their fair value and there's nothing to replace them with. So we're building cash as the market moves higher. And of course, the exact opposite: as the market goes lower, more opportunities are created. So you're moving money back into the market. So it's a natural hedging system. I have a lot of cash right now, more than 50% in everything but the income portfolio and the bank stock portfolio. Sorry, that's at 65% invested. But we have a lot of cash in the portfolios.
And basically, that's just because you don't see the value out there, so it naturally puts you into cash, right?
Exactly. It's not a statement or any wonderful wizard market timing on my part. I can assure you, it's just the fact that there's nothing to replace the stocks we're selling.
Oh, anyways, okay. Well, thanks a lot, Tim. Really appreciate everything. But just before we end, actually, do you see anything like potentially that's overvalued? Because we always say, our traders do like to go short. Do you see some stuff like a specific, like you said, everything looks overvalued? But do you see something specific, that's you're really saying like, wow, I can't believe this thing's trading at this price, and if I was to go short something, this is the stock I would short.
Obviously, all of the social media stocks.
Yeah, all
I
this
knew he was
stuff.
going to say that.
But two things that I'm telling everybody to avoid right now are the really large cap dividend paying blue chips across the board. McDonald's, Coca-Cola, pick one. They're overvalued, ridiculously so. If you look at current earnings, past earnings, and even the ridiculous estimates of future earnings, are all showing single digit growth going forward. And I think that's a little pie in the sky, to be honest with you. And then the large cap REITs they're ridiculously priced.
What's an example of one of those?
Simon Property Group, Avalon Bay,
Okay.
all of those, I think, they're trading for far more than you could actually sell the property portfolio for. Sub 4% dividends. They're ridiculously overpriced because of money flows searching for income.
Right.
And that's the case with the blue chips too. There's a lot of money going in there buying these stocks pretty much no matter what, and I don't think they're at sustainable levels.
Okay, just to close it out here, we've been talking just that whole thing that you're talking about, value investing versus momentum investing. Berkshire Hathaway has just been on a tear here,
Really nice.
making new all-time highs. You think that's just symptomatic of the investors looking for value? And I know it's hard to to trade or to evaluate his stock, but 5-point move here in the last 3-4 trading sessions. I mean, obviously, do you have an opinion on this, or what's your view?
Berkshire Hathaway is just such a great collection of businesses, and you can't really call Warren a deep value investor anymore because he's too big, and he's admitted that if he was a lot smaller, his portfolio would probably look a lot more like mine. But today, that's an incredible collection of businesses that throws off a lot of cash flow. The annual meeting's coming up. The report was just out, so I think there's just a little buzz around the stock right now. Do I think it's particularly cheap? No, and neither does he. If he
Right.
did, he'd be buying it back. So
Okay, all right. We've had Tim Melvin of the Tim Melvin Deep Value Letter. You can find his product on MarketFi. And Tim is like he's like our reality check, Dennis. You know, it's like we talk
boy,
about
are you guys in trouble?
we, no, we need it, because you talk about all the short-term fluctuations in the market and the upgrades and the downgrades, and it's just good to hear someone that just doesn't give a hoot. That they have their models and their discipline. That's something like we'd like to talk a lot about with our traders, and it's always great to have you on, Tim. Enjoy your day and get you back on soon.
All right, thanks a lot, guys. Always good to be on.
Okay.
Thanks, Tim.
Bye-bye, guys.